Welcome back to the deep dive. Today we're going to tackle index funds.
Right.
And I think we should probably start with maybe like a quick, why would someone even want to learn about index funds in the first place?
Yeah.
They're often touted as like this great way to grow your money.
Yeah. Definitely a popular topic these days.
And they're supposed to help you kind of like ride the wave of the stock market without having to like pick individual stocks yourself.
Right, exactly. And there's this fascinating example about the impact of fees on your return.
Oh, yeah. Tell me about that.
So, imagine two funds, they both grow at 7% a year before fees. Sounds pretty good, right?
Yeah.
But one fund, let's say it's actively managed, it has an expense ratio of 1.2%.
Okay.
The other fund, an index fund, has an expense ratio of just 0.2%.
Okay, so a whole percentage point lower.
Right. Seems small, right?
Yeah.
But over 30 years, that tiny difference can lead to a gap of almost $90,000.
Wow, seriously.
Yeah, seriously. It's the power of compounding.
That's wild. Okay, so that's definitely a good reason to pay attention to fees.
Absolutely.
But let's back up for a sec and break down how index funds actually work.
Okay.
You always hear about them tracking a market index, right?
Yeah, that's the core idea.
But what does that actually mean?
So basically think of an index fund as like a pre-assembled portfolio.
Okay.
And it's designed to mirror the performance of a specific market index, like let's say the S&P 500.
Right.
So instead of trying to pick individual stocks yourself,
Yeah.
you're essentially buying a slice of the entire market.
Yep.
And the fund automatically adjusts its holdings to match the index's composition.
Oh, that's interesting. So
Yeah.
if a company gets added or removed from the index, the fund automatically follows suit.
Exactly. It takes the guesswork out of stock picking, and it helps you stay aligned with the overall market trend.
Got it. But the S&P 500 is just one example, right?
Yeah, of course.
What are some other popular indexes that people invest in?
Well, you've got the Dow Jones Industrial Average that tracks 30 major industrial stocks.
Okay.
And then there's the tech-heavy NASDAQ 100.
Right.
Those are all U.S.-focused, of course.
So what if I want to invest in companies outside the U.S.?
That's where international indexes come in. A popular one is the MSCI EAFE index, which focuses on developed markets in Europe, Australia, and the Far East.
Oh, interesting.
You could even explore emerging markets with a different index.
So many options. I like it. And wait, aren't there also index funds for bonds?
You got it. For example, the Barclays Capital Aggregate Bond Index covers a wide range of U.S. government and corporate bonds.
Okay.
And there are even more specialized index funds focusing on specific types of bonds like high yield or emerging market bonds.
Wow, so stocks, bonds, international markets. It's starting to feel like you can invest in pretty much anything with index funds.
You're catching on. Think commodities, real estate, even currencies.
No way.
There's pretty much an index fund for anything these days.
That's incredible.
Yeah.
So much variety.
It allows you to really fine-tune your portfolio based on your risk tolerance and investment goals.
Okay. This is all super interesting. But before we get too carried away with all these options, we should probably talk about the risks involved, right?
Definitely. We can't ignore those.
Because, index funds aren't like a magic bullet that protects you from market downturns, right?
Right, exactly. It's important to remember that index funds offer diversification, but they don't eliminate market risk.
Okay, so diversification is key, but I also need to be comfortable with the fact that the market can go up and down.
Precisely. And another thing to keep in mind is that with index funds, you're not going to significantly outperform the market.
Oh, that makes sense.
Yeah.
Because you're essentially just tracking the average market return, right?
Exactly. If you're hoping to hit those massive home runs with individual stock picks, index funds might not be the right approach.
Got it. So index funds are more about the slow and steady growth, not necessarily about trying to beat the market.
That's a good way to put it.
Okay, but even with those risks, index funds are still super popular.
Yeah, for sure.
And I know we talked about the lower fees, but there's got to be more to it than that, right?
Oh, absolutely. There are a lot of other benefits that make index funds such an attractive option for investors.
Okay, well, let's dive into those then.
Sounds good.
Okay, so we've talked about the risks, but now I'm really curious about these other benefits that make index funds so appealing.
Yeah, let's dig into that.
Besides the whole low fee thing, which we already touched on.
Right. So as we mentioned earlier, those lower expense ratios can really make a difference over time, especially compared to actively managed funds.
Yeah, those actively managed funds with their teams of analysts and fancy algorithms, they got to charge more to cover those costs, right?
Exactly. And those higher fees eat into your returns.
And with index funds, you're basically skipping all that and just tracking the index.
Right. Which keeps the costs down.
So it's kind of like choosing between a fancy restaurant with a huge bill
Haha. Yeah.
and a delicious home-cooked meal that's easy on the wallet.
I like that analogy.
Right.
And it really highlights how those seemingly small differences in fees can add up over time.
Yeah, like that almost $90,000 difference over 30 years that we talked about earlier.
Exactly. That's the power of keeping those fees in check.
Wow, okay. Low fees, check. What else is there?
Well, another big advantage is simplicity.
Oh, yeah, that's a good one.
With index funds, you don't have to spend hours researching individual stocks or trying to time the market.
Yeah, that sounds exhausting.
Right, you're basically outsourcing all that work to the index.
Okay, so it's like a more hands-off approach,
Exactly.
which I guess is perfect for people who don't want to constantly be checking their portfolios or like stressing about individual stock picks.
Right, and it frees up your time and energy to focus on other things.
Makes sense.
Yep.
And speaking of taking the stress out of investing, diversification is another key benefit, right?
Absolutely. By investing in an index fund, you're instantly spreading your risk across a whole basket of assets.
Yeah, instead of putting all your eggs in one basket with a single stock.
Right, exactly.
Okay. But can't you also achieve diversification with actively managed funds?
Yeah, you can definitely diversify within an actively managed fund.
So what makes index funds different in that regard?
Well, with index funds, you're getting diversification that's tied to the specific rules of the index.
Oh, okay. I see.
It's not based on a fund manager's judgment or potential biases. You're following a predetermined, transparent methodology.
So it's like a more systematic rules-based approach.
Exactly.
Got it. So we've got low fees, simplicity, diversification. Those are already some pretty compelling reasons to consider index funds.
Right. And there's another one that often gets overlooked:
Oh, what's that?
tax efficiency.
Tax efficiency. Okay, tell me more.
So because index funds are passively managed, they tend to have lower turnover rates.
Meaning they're not constantly buying and selling stocks, right?
Exactly.
Okay.
And that can result in fewer taxable events, which can help you keep more of your gains.
Oh, so lower taxes are another potential perk.
Yes, indeed.
Wow. I'm starting to see a pattern here. Lower fees, simplicity, diversification, tax efficiency. These are all sounding pretty good.
They really are.
And you said earlier that the historical performance of index funds has often matched or even exceeded that of actively managed funds over the long term.
That's right. Numerous studies have shown that over long periods, it's incredibly difficult for actively managed funds to consistently beat the market.
Especially after you factor in those fees, right?
Exactly.
Okay, so it's not just theory. There's actual evidence to back it up.
Precisely.
So if index funds are so great, how do I actually choose the right one?
Ah, that's the million-dollar question.
Right, because we talked about all those different types of indexes earlier.
Yeah,
It's a lot to take in.
it definitely can be.
So where do I even begin?
Well, choosing the right index fund can be tricky. There are a lot of factors to consider.
Right, well, let's break it down then.
Yeah.
Lead the way. Okay, so we've covered like the what and the why of index funds.
Right.
But now I'm kind of stuck on the how do
Yeah.
I actually choose the right index fund for me?
Well, there are definitely a lot of options out there.
Yeah, it feels kind of overwhelming, to be honest.
I understand. But don't worry, we can break it down.
Okay, good.
So the first thing you want to think about is your investment goals.
Goals. Okay.
Yeah, like what are you actually hoping to achieve with these investments?
Okay, that makes sense. Because like my goals will probably influence what kind of index funds I choose.
Exactly.
Yeah.
For example, if you're saving for retirement way down the line, you might be more comfortable with index funds that focus on growth stocks
Got it.
because you have more time to ride out any market ups and downs.
Right, right. But if I'm saving for something like a shorter term goal, like a down payment on a house,
Yeah,
then I might want to choose index funds that are a little less risky.
exactly.
Yeah.
You might prioritize bonds or a more conservative mix of stocks and bonds.
Okay, so goals first. Got it.
Yeah.
What's next?
Next, think about your time horizon.
Time horizon.
Yeah, how long are you planning to invest this money?
Okay, so like if I have a longer time horizon,
Mm-hmm.
I can be a bit more aggressive.
You got it. A longer time horizon gives you more flexibility to handle market fluctuations.
Makes sense. Okay, so I've got my goals. I figured out my time horizon.
Right.
Now what?
Now you can start looking at specific index funds.
Okay.
And remember, even within a specific index, like let's say the S&P 500,
Mm.
there can be differences between funds offered by different providers.
Oh, really?
Yeah, so it's not quite as simple as just picking any S&P 500 index fund and calling it a day.
So what kind of things should I be looking for?
Well, first make sure you compare those expense ratios.
Right, those pesky fees.
Exactly. Even small differences can add up over time, so choose the fund with the lowest cost if all other factors are equal.
Okay, low fees are a priority. Got it.
Right.
What else?
Pay attention to the fund's tracking error.
Tracking error. What's that?
It basically measures how closely the fund's returns match the returns of the underlying index.
Oh, okay. So a lower tracking error means the fund is doing a good job of actually tracking the index.
Right. You want a fund that stays true to its benchmark.
Makes sense.
Yeah.
Anything else I should be aware of?
It's also worth checking out the fund's trading volume and assets under management.
Okay, trading volume. I think I get that.
Yeah.
But what's assets under management?
It basically tells you how much money the fund is managing.
Oh, okay.
Larger funds sometimes have an advantage because they have more resources,
Right.
and they can often negotiate lower trading costs.
So size does matter in this
To
case.
some extent, yeah.
Wow, okay, this is a lot to think about.
It is, but remember, it's all about finding the right fit for your individual needs.
Right. It's not just about picking a random index fund.
Exactly. You want a fund that aligns with your goals, your time horizon, your risk tolerance.
It's all connected.
Precisely.
This has been so helpful.
Helpful?
I feel like I have a much better understanding of index funds now.
I'm glad to hear that.
Any final words of wisdom before we wrap up?
My advice is to keep learning and exploring. The world of investing is constantly changing.
Yeah, that's true.
So stay curious, ask questions, and don't be afraid to seek out guidance when you need it.
Awesome advice. Thanks so much for sharing your knowledge with us today.
It was my pleasure. Happy investing.
And to all our listeners out there, thanks for joining us on this deep dive into index funds.
Yeah, thanks for listening, everyone.
We hope you learned something new today and that you feel more confident about navigating the world of index funds. And remember, knowledge is power. So keep exploring, keep learning, and keep diving deep. Until next time.